Mutual fund marketing methods. The fund to underwriter to broker-dealer to investor. When an investor gives an order to a broker-dealer, the broker-dealer places an order with the fund underwriter. To fill the order, the fund sells shares to the underwriter at the current NAV. The underwriter sells the shares to the broker-dealer at net asset value plus the underwriter's concession. The broker-dealer then sells the shares to the investor at the full public offering price. So the investor always pays the ask price. The total difference between what the public pays and what the fund receives is called the spread. We talked about this. The underwriter's concession is part of the spread. The fund to underwriter to investor, it's possible that the underwriter uses its own sales force to sell shares to the public. In that case, the entire sales charge is split up among the underwriting broker-dealer and their registered reps. Some mutual funds do not charge a sales charge, thus they sell the shares directly themselves. These are no-load funds. So when they sell directly to the public without the use of a sales force and without a sales charge. If there is no load, bid equals ask. As described in the prospectus, some mutual funds will offer quantity discounts. We call those breakpoints. If you're going to see a breakpoint, it's most likely to appear on a Class A share. There's an example within the PDF of a sample breakpoint chart. It has a 5% sales charge of an investment of $1 to $9,999. If someone's going to invest $10,000 to $24,999, then the sales charge goes down. So this idea of who qualifies for a breakpoint is generally on the test. Breakpoints are available to any person as defined in the prospectus. Most investment companies consider a family unit to be one person. So you and any minor children, you and your spouse. You and your adult children, however, would not be considered the same person. Investment clubs or associations formed for the purpose of investing do not qualify for breakpoints, but qualified retirement plans do. So this large lump sum investment, if in that example you were going to put in $15,000, you would have a 4% sales charge instead of the 5%. Not everybody can do that, however, so many funds will offer the investor the ability to sign what's called a letter of intent. A letter of intent is good for 13 months, where they agree to invest enough to get them over the break point in the next 13 months. If that's the case, then we will charge them the reduced sales charge on their initial investment. They have 13 months to satisfy their letter of intent. If they don't satisfy their letter of intent, the mutual fund will hold some of those shares in an escrow account to pay the additional sales charge. So for example, let's say you invested $15,000 and I say, well, you can put in $10,000 more and you'd have a 4% sales charge, and you said, oh, okay, in the next 13 months I can do that. If you don't fulfill the next $10,000 like you agreed to, there's going to be enough shares in an escrow account for me to sell and pay the additional 1% sales charge. Maybe you don't want to sign a letter of intent. So sometimes you'll have a client that says, no, thank you. But then a month later, they get an inheritance of an amount of money that's significant. So they call you up and go, oh man, you can backdate a letter of intent up to 90 days. So that in that case, we would make sure that the average sales charge was whatever. In that example, I was using a 4% sales charge. So you can backdate a letter of intent up to 3 months, 90 days, which gives the investor an additional 10 months going forward to fulfill the letter of intent. Something that's important to remember, the letter of intent has to do with sales charges, getting a reduced sales charge. So if the client elects to automatically reinvest dividends and capital gains, those do not count towards fulfilling a letter of intent. Because the automatically reinvested dividends and capital gains, there is no sales charge at all on those. So automatically reinvested dividends and capital gains do not count towards fulfilling a letter of intent. Most mutual funds will offer the investor the right of accumulation, so that maybe your client's putting in $50 a month, and after a period of time, everything that's in their account and what they're currently purchasing will get them over, in the PDF's example, the $9,999 balance, and from that point forward they will be subject to the reduced sales charge. So their first investments until their account breaks through the break point is subject to the higher sales charge. It's called the right of accumulation. In order for an investment company to charge the maximum sales charge allowed under FINRA rules, and what was that again? Yeah, 8.5%. The fund must do these three things. Allow for the automatic reinvestment of income distributions. These are the capital gain and dividend distributions without a sales charge. So that's the first thing that they must allow. They must also have a schedule of breakpoints, and they must offer the right of accumulation. Now, honestly, most funds don't charge the maximum sales charge allowed, but if they wanted to, they would have to do these three things. If the mutual fund does not offer all three of these things, then the maximum sales charge is reduced to 6.25%. The maximum sales charge allowed if the fund does not offer a break point, the right of accumulation, and the right to reinvest income distributions without a sales charge goes down to be 6.25%. As described in the prospectus, most mutual funds will allow investors to combine purchases within the same family of a mutual fund towards qualifying for breakpoints. So maybe your client has one account that's a growth fund, and then they also have some money in an income fund. Most funds will allow for the combination privilege. The exchange privilege. As described in the prospectus, funds can allow for the investor to switch. I briefly talked about this earlier. So this idea that you got into the growth fund, let's say many moons ago, when the bid was $9.50 and the ask was $10. And today, many, many years later, you want to switch into the income fund. So today, the growth fund has a bid, let's say, of 40 and an ask of 42. So the value of your shares in the growth fund, net asset value per share, let's say you have 10,000 shares, you're allowed to take these dollars, put them into the income fund at NAV per share. Another way of saying this is without a sales charge. No sales charges. This is the privilege, the fact that you can do so without a sales charge. But it's really important, if your client ever wants to do this, that they understand that the IRS will look at what they paid, the $10 a share, what it was worth when they did the exchanging. So we've got a long-term capital gain that is taxable, $30 a share, even though the investor didn't get any of the money. They put all of the money into a different fund within the same family. So the exchange privilege can create a tax liability for your client. The people that I know that have had this happen to them have always said to me, if somebody had explained that to me, I would have never done it. So it's really important that the client understands they possibly are going to have to sell some of their shares to pay the tax bill that they just created. Open-end mutual funds must redeem the client's shares within 7 calendar days. We talked about that. They're very liquid. They are redeemed at net asset value per share. We know that must be calculated at least once every business day. It's always forward pricing. Open-end investment companies are always new issues. So when you don't want your share, you don't sell it. It's not marketable. That would be a closed-end fund or an exchange-traded fund. These are redeemable shares. Once it is redeemed, think about it like it's thrown away in the garbage can. Nobody else will ever own it. Open-end shares, continuous primary offering. They may not be purchased in a margin account. It is a new issue. Whenever you sell a new issue under the Securities Act of 1933, you must give out a prospectus. Of course, there's electronic delivery required for any paperwork that we talk about, but I always say you give it to the client. It's just the way it's always been historically. It sounds so much better, but it can be given electronically. Access equals delivery in today's internet age. That is true. Some open-end funds will allow the client to have what is called a withdrawal plan. So instead of taking a lump sum redemption out of your open-end mutual fund account, to begin to take money out over time. So the SEC is really concerned that a client might confuse this with an annuity. So an annuity will come up later on in this chapter, but this idea that with an annuity you cannot outlive the monthly payments for life. And a withdrawal plan is nothing like an annuity. You can definitely liquidate your account under a withdrawal plan. All withdrawal plans pay out monthly. So that's important to remember. All withdrawal plans pay out monthly. Dividends and capital gain distributions are automatically reinvested during the withdrawal plan. So the client can choose a fixed dollar plan. Maybe they want $500 a month. So every month a different number of shares will be redeemed. They can choose a fixed percentage or a fixed share plan. So maybe redeem 10 shares a month. The value of the shares will change every month so that the check amount will be different every month. Fixed time plan says, I want this money to last for the next, let's say, 10 years. That's 120 payments. Don't forget, withdrawal plans pay out monthly. So it's very possible that you will liquidate the plan, and especially the fixed time plan is always self-liquidating. Most mutual funds will require a certain dollar amount, a fairly high threshold amount in the account before the investor can begin any withdrawal plan. Most funds will also discourage the redemption and purchase of funds at the same time. It makes no sense to buy $100 worth of shares and redeem $50 worth of shares every month. You'll always be at a loss, the difference between the ask that you buy at and the bid that you redeem at. So you should never do that. You shouldn't buy and redeem all at the same time. So they always discourage people. If you begin a withdrawal plan, you should not be putting any more money in. Withdrawal plans are normally a free service offered by the investment company. They are not annuities. They are not guaranteed. The SEC is very concerned that they might be misrepresented. The client needs to understand that withdrawal plan can never promise the investor a guaranteed rate of return. The client must understand that it is possible to exhaust the account, and there must be no use of any charts unless they are specifically cleared for use by the SEC. So they can't make any withdrawal plan charts. They can't use those unless they've been specifically cleared for use by the SEC. Distributions from mutual funds. So we talked about this, but it doesn't hurt to review. So we've got the mutual fund, we've got the board of directors, we've got the fund's portfolio, and we know that it's managed by the investment advisor. And when we were talking about the balanced fund, we talked about it has stocks, it has bonds. Now, we also know that the appreciation of the portfolio is what makes the share price go up, NAV per share. Depreciation of the portfolio is what makes the share price go down. We know the largest expense of the fund is the investment advisory fee. So the investment advisor is going to choose to buy and sell assets in the portfolio to maximize the return for the client. And sometimes they're going to buy a security, sell it later, and have a gain. And there's some things in the portfolio that have created a loss for the fund. So the fund nets together its gains and its losses and distributes capital gains to the investor. Capital gain distributions can be done at most to the investor one time a year. So these are long-term capital gains. So a lot of times funds do this in December, capital gain distributions. It's usually better to buy the shares after the distribution has been made. For example, you buy mutual fund shares on December 1st. December 15th, the fund makes a capital gains distribution, which is going to go to you. You only held the share for 15 days, but it's the holding period of the fund that determines that it's a long-term capital gain to you, the investor. So you get the long-term capital gain distribution. It's taxed on your personal return. So oftentimes, if you can wait a few weeks, it's just better to wait those few weeks. We talked about from the stocks we receive, the portfolio receives dividends, and from the bonds it receives interest, and that these two things made up the fund's gross investment income. Out of gross investment income, we subtract operating expenses. So if the fund has a 12B1 fee, the investment advisory fee, largest expense of the fund, the custodian fee, the transfer agent fee. We know the sales charge is not an operating expense. The result is net means after expenses, net investment income. It's out of the net investment income that we flow the dividends. So down through the pipeline, through the conduit, we said earlier, the dividends can be paid at most quarterly, just like the rule on common stock, at most quarterly. So as an investor, how do you know what you owe taxes on? The transfer agent's going to send you a 1099, and the 1099 is going to describe on a per share basis your long-term capital gains distributions. It's actually going to show it cumulatively, and your dividend distributions. Please consult the current year's contribution limits for any tax law changes that may have recently took effect. So long-term capital gains are taxed at long-term capital gains rates, which generally are going to be determined by your income tax bracket. So I don't get into all of the nitpicky details of what they are because oftentimes they change, and the test will talk about, is it ordinary income, a long-term capital gains distribution? No, it's a long-term capital gain. It probably won't talk about at what rate. The test hates to change things that change all the time. That's just, from years of experience of doing this. So long-term capital gains are taxed at long-term capital gains rates. The 1099 is also going to describe your dividend. Whether or not the dividend is taxed as at long-term capital gains rates, whether or not the dividend is taxed at ordinary income rates also depends upon the client's tax bracket. So please make sure to consult the current year's contribution limits PDF. It has not only contribution limits, but any tax law rules that you should be aware of for the year of your exam. They're all described for you in there. So how do we know how much was long-term capital gain and how much was a dividend? It is found on that form 1099. It's important to remember that the price of a mutual fund share, its net asset value, if you will decrease by a distribution made by the fund. So as of what we call the ex-dividend date, the net asset value of the share of the mutual fund will go down by the amount of the dividend. The ex-dividend date for a mutual fund is set by the mutual fund's board of directors. So if you get the dividend, you owe taxes on it. If you wait till the ex-dividend date, then the NAV per share goes down by the amount of the dividend. Very often it's better for the client to wait till the ex-dividend date or later to buy the share, because when they get the dividend, they owe the taxes. If you don't explain that to the client, you have violated the FINRA rule regarding selling dividends. It's usually the day after the record date. The ex-dividend date on a mutual fund, it's set by the board of directors. It's usually the day after the record date. The record date is the day that an investor's name needs to appear on the books and records of the mutual fund company in order to receive the dividend. So usually mutual funds don't go ex-dividend until after the record date, but it is determined by the board of directors. How often can a fund distribute capital gains? At most, one time a year. At most, one time a year. We talked about how as the shareholder you have no control over the timing of that distribution. So let's say on a per share basis your capital gains were $2 and your dividends were $3. You could take those in cash. You could elect to take those in cash. So your $2 long-term capital gain per share, your $3 dividend. If you take them in cash, they're taxable in the year of the distribution, right? But what if you don't take them in cash? What if you automatically reinvest them? They're still taxable. So it's important to remember that, or remind your registered reps underneath you to remind their clients that automatically reinvested dividends are still, and capital gain distributions are still taxable. They're taxable in the year of the distribution. So if you bought this mutual fund share when the bid was $9.50 and the ask was $10, and you automatically reinvested the $2 and the $3, it has the effect of increasing the investor's cost basis. Automatically reinvested dividends and capital gains increase the investor's cost basis. So at this point, the cost basis per share is 15. So if later on they redeem at a bid price, let's say of 19, ask of 20, it's important that they remember this 15, that includes automatically reinvested dividends and capital gains, so that they only owe long-term capital gains on $4 a share. To have a long-term capital gain, the investor must have held that share for 1 year and 1 day or longer. If the holding period is a year or less, that's a short-term capital gain taxable at ordinary income rates. So don't forget that it's always a taxable event, any income distributions out of a mutual fund, whether or not you take them in cash or you leave them in the fund. They are always a taxable event. When you leave them in the fund, they have the effect of buying you more shares. Mutual funds do not make short-term capital gain distributions. They don't. There's only long-term capital gain distributions. But it's possible that the investor bought shares, let's say at $10 in January, and sold them at $11 in June of the same year, and that they have on their mutual fund a short-term capital gain, which is taxed as ordinary income. So 1 year or less of a holding period, ordinary income. If the client bought the shares at an ask price of $10 and now they're worth $27 a share, but the client has not yet redeemed them, they do not owe any taxes yet. That's called unrealized appreciation. Taxes are only owed on realized appreciation. So cost basis is after-tax dollars that go in to buy these shares. We're not in a qualified plan, not yet. We already talked about automatically reinvested dividends and capital gains increase the investor's cost basis. Total return from a mutual fund includes income distributions, capital gain distributions, and share appreciation. Current yield is only based upon dividend distributions in the last 12 months. So it's important to remember that if a fund prepares an advertisement, they can't compare their total return to another fund's current yield. They're really not the same thing. So the total return of the fund, let's say that the dividends were $1, capital gains were $2, and let's say the current market price is 10, but a year ago it was 8. Okay, so this is appreciation. So the current market price is 10, current market price, but a year ago it was only 8. So we've got 5 divided by 10, ooh, total return of 50%. I want that. But if you were to compare it to current yield is the dividends of $1 divided by the current market price of 10. That's only 10%. So they can't do that. They can't advertise our fund's total return and another fund's current yield. They're not comparable. The conduit theory, what's called Internal Revenue Code subchapter M. If a mutual fund is described as a regulated fund, regulated by the IRS, what it means is they follow the conduit theory. The conduit, the pipeline, the flow through of, at minimum, 90% of the fund's income. So this includes capital gain distribution and dividend distribution. So this idea, so out of net investment income comes the dividends, down the pipeline, through the conduit. The least that the fund can distribute of their long-term capital gains, one time a year, the least that they can distribute of their dividends, and not be taxed on their net investment income, not be taxed on their capital gain distribution, is 90%. So let me give you an example. If the fund distributes, instead of 90%, 89%, they do not follow the rule, 100% of their net investment income and 100% of their capital gains would become taxable. So most funds want to follow the rule. So let's say that they distribute 95%. 95%. The 5% they kept is taxable to the fund. So whatever they don't distribute, once they get to 90% or better, whatever they don't distribute is taxable to the fund. So it's this idea, if you think for a minute, the portfolio is made up of stocks and bonds. So on a stock, the company pays the IRS taxes, and then out of their after-tax income, they pay a dividend. And then the mutual fund takes those, puts it into gross investment income, pays operating expenses, and then pays a dividend, and then the investor pays taxes. So the question is it triple taxation or not? Are we going to tax the fund on its net investment income and capital gain distributions? If it's regulated, that means it follows this rule. The least it can distribute is 90%. The most it can distribute is 100%. If they distribute 98%, the 2% they kept is taxable to the fund. They distribute 85%, then 100% is taxable to the fund because they did not follow Internal Revenue Code subchapter M, the conduit theory. It's important for the client to understand that the difference between what they put in to buy the share plus any reinvested dividends and capital gains, if they have any, that's their cost basis. And then whatever they redeem their share at, if they make money, that's a taxable gain, short or long term, depending upon the holding period. If they lose money, then it's a loss. Losses can be net against their gains. We'll talk about that in a minute. Accounting methods for cost basis of shares. Effective January 1st of 2012, mutual funds are required to disclose the investor's cost basis to the IRS for shares purchased as of that date, so January 1st, 2012 or later. For shares purchased prior to that date, the rule for keeping track of your cost basis really fell upon the investor. So now the IRS has passed that on to the mutual fund. So the mutual fund is responsible for keeping track of the investor's cost basis. How do they do that? As part of the account opening process, the fund will ask the investor which method they would like to use for cost basis reporting. Choices typically include an average cost basis, LIFO, which stands for last in, first out, FIFO, first in, first out, and some other methods of specific share identification. Mutual funds will also have a default method for their cost basis reporting. There is no standardized choice, however, that funds must follow for their default method. So it's really important that you and the persons that you supervise understand what your firm's default method is. From a sample of different mutual fund companies, there's really not any one standard. The minute I think that one's more popular than another, I'll contradict myself. So there is not any one that it need be. It's just whatever the company chooses, because sometimes they never hear back from the investor. The investor hasn't told the fund what they want to use for the cost basis method. Average cost basis is one that I did find a lot of funds use, but not all of them. So there's just not any one specific one. There's no rule, no law that says what it has to be. It is important to note that the investor can always change the method for reporting cost basis by giving notification to the mutual fund company. Choosing a first in, first out cost basis will generally create the largest reportable gains, since the shares you purchased longest ago are usually the ones you paid the least amount of money for. When using specific share identification, the investor has the most flexibility to reduce their investment-related taxes. Generally, it's the easiest way for gains to be accounted for using an average cost basis. So specific share identification is usually most flexible for reducing investment-related taxes, but the easiest way to do it, which does tend to be a default method for many funds, is the average cost basis. The mutual fund company simply calculates the average cost basis for the investor by dividing the total cost of all shares purchased by the total number of shares owned. When more shares are purchased, the average cost is recalculated. This average cost is then subtracted from the net asset value at redemption in order to determine the amount of the gain.